So yeah, so JobKeeper I was going to go through a few points. We'll cover a little bit about JobKeeper and then some year-end tax planning, and then we'll move on to Tom and Nick, and they'll be talking a little bit more about some of the I guess the more current things as we're coming out of the whole hibernation sort of phase, if that's what businesses are doing now. So we've done a number of webinars, which a few of you I think have been on already. So you probably, if there's anything much, there's probably not, how much more can we really say about JobKeeper that hasn't been said the last couple of months. Just to probably recap on a couple of the specifics, now that we've got through all the implementation phase, we're really up to those businesses that are in JobKeeper, and for those of you that are advisors, your clients, you're there receiving payments, so they've done all the turnover tests and registrations, except if the businesses, and I know we've got a couple where they didn't qualify at the beginning, but they are starting to see that impact, probably slightly delayed impact. So we're still seeing a couple of businesses qualifying for June, so they'll have until 30 June to sort out their turnover testing calculations and get the registration in. And then we're up to payments are definitely coming through. And again, you're at that stage where you need to lodge the monthly reports in order to get the JobKeeper payments. And so obviously for June, now that the date is the 14th of the next month, so by 14th of July, those that are already in the system will be lodging those monthly JobKeeper reports with the employee numbers, which is obviously critical to determining the claim, and also the turnover numbers, which certainly the ATO says is just for information, for information checking. Although as we see what the employment, the enforcement action is going to start to come, as we always knew it would. So some of the statements by the ATO are starting to ramp up. So we will expect to see more reviewing and enforcement at that stage. So that's where obviously record keeping, determining that having all the declarations from employees on file, records as to which employees you've actually determined qualified. Obviously, most critically, the turnover threat determination calculations as to actually meeting the basic requirements, but particularly the turnover tests. So that's where we're going to see the ATO come back and start reviewing that, and so you really need to be able to justify and look at things like projections. So again, Tom will touch on a bit more about where things are now, but I know that's something when we're evaluating JobKeeper, that's one of the things we're very focused on, that if people need to rely on projected turnover, how confident were they in the projections, and how much again do they have to back up the projections. As I mentioned, we can still register for later periods. So we are still having clients looking at, they didn't fit in initially. In some cases, they might have said, oh, look, that's not going to apply to us, forget it. Now a couple of businesses are starting to see some impacts. So they are still looking at it, saying, well, okay, I missed out for the first couple of months or for the June quarter, but maybe I can still get in. And as things stand, unless the government makes further changes to the system, which obviously there's been a bit of talk about, then they can still get in, and as the rules stand, once they're in, they're in. So it's definitely something that's worth keeping in mind. Again, just a couple of basic points. The equivalent of $1,500 a fortnight. So certainly it's now it's critical that people receive those payments. They can receive it as a monthly. If you're doing a monthly pay run, it's certainly fine to pay employees monthly as long as they're getting that equivalent. And so it's just something, they're the sort of things you need to keep an eye on to make sure you're continuing to meet all the requirements. Look, it's probably pretty much all I wanted to cover there, Nicola. And obviously, if anyone's got any questions about JobKeeper, but again, it's just been so widely discussed. So then I'll probably move on to a little bit about, but we're coming up to 30 June. So planning for 30 June and beyond. A lot of it is, and we're thinking about businesses and also from an individual perspective. So for those of you, particularly those of you who are advisors who are thinking about your individual clients as well, the a lot of it is the usual things that you would be looking at anyway. For private companies, Division 7A loans, obviously always a year-end consideration. Particularly this year, we feel that if you're going to, as often private companies need to do, is to look at dividends. If there's been drawings during the year, if there's loan accounts, or if there are minimum repayments that need to be made from prior years, if there are these Division 7A loans, what's the profit position looking like in the company to actually declare the dividends? What are the franking and credits, particularly if they're paying less tax? And maybe that impact might not be felt as much this year, but certainly as you go into the next year, if profits and franking credits are down, say they're varied, maybe they're varied installments, or if it's down in the following year, then that's going to start to have an impact on the ability to deal with and service these Division 7A loans. And in a more practical sense, which is what, again, probably ties into what Tom will be perhaps talking about, we think about it in terms of, business owners are borrowing from their private companies, so that can be a short-term fix, and perhaps helps get them through if the cash is there in the company. But what happens then? And that really gets into the state of the business, and what is the more medium, longer term solution if there are cash flow issues for the business owners and the business themselves. So it's just something that we need to think about. We talk about investment structures. Again, with what the markets have been doing, look at capital losses. If there are capital losses there, obviously it's an investment decision whether you cash in for the investments. But as far as from a tax planning perspective, if there's some capital losses there and you feel that it is an appropriate thing to do, then consider whether to realise capital losses now, particularly if there are gains there, perhaps gains from earlier in the year, and at least make use of them while you can. The last thing you want is to have some capital gains this year and some capital losses next year that you then might have trouble using. So a bit of planning around that is useful. You'll always be looking at income splitting, negative gearing sort of situations. When incomes are decreasing, where does that leave people? Incomes might be down generally. Negative gearing losses might even be higher if the income is down. So just looking at clients' position, and maybe it might be a bit different this time around than in other years. From a personal and business sort of tax planning perspective, if you're looking at refunds because perhaps incomes are down, then considering lodging particularly personal or any returns, but perhaps individual returns early. Although you temper that from an individual perspective. I know the ATO's official line is that people are going to be in a hurry to lodge their returns, but on the other hand, with the pre-filling information that comes through, any of you that are involved in individual tax returns, or if you're looking at your own returns, then a lot of the pre-filling information needs perhaps a month or so, or perhaps longer if people have managed fund distributions, in order to actually come through. So if people are going to rely on pre-filling information and they do their returns early, then they might be missing things. So I just have to be a bit careful around that. Another area this year is particularly topical is obviously working from home deductions, which I've had quite a number of discussions in the last month or so with people around that. Being aware that the ATO has, obviously people are doing a lot more working from home. The ATO has implemented this 80% shortcut method, 80 cents per hour shortcut method. And so that is an alternative, just to be clear, in case people are not completely across that. There's an alternative to the existing methods. So someone who is working from home can work out all of their working home office deductions, which would be things like power, electricity, heating, lighting, internet, use of computer equipment, perhaps depreciation, or buying if they're sort of small items, all those things like that. If as long as they're incurring the costs and not being reimbursed by their employer, you can look at actual, and you've got to track your actual usage. So people could use all their actual costs, there is the ability to have a there's a was it 52 or 54 cents per hour sort of method that was already available, which doesn't cover everything like internet costs and things like that, but that's more the heating and lighting. Just as a general comment, people wouldn't be covering. You have to be careful not to cover things like mortgage interest, rates and taxes, sort of, actually occupancy, those sort of costs, because that's, if you're running a home business, yes. If any of you are operating a business, or if you're, then that would be, certainly that's a different story. But of course, then that has an impact, because if you're running a business, partly running a business from home, then when you go to sell your home, you also don't get your full CGT exemption for the main residence. So there's a trade-off there. If you're renting, of course, that's not an issue. But for people who are employees and they're working from home and they're not actually running their business from home, then it's not, you don't go that far. So the 80 cents is it's meant to be a simple method. So all you've really got to keep is timesheets, and but it's still got to be then it's a matter of tracking, having a dedicated area and tracking, but then also tracking the hours is really the key thing there. So just to finish up on a couple of points, I know there's one question which I'll address Paul's question. Paul Bailey's raised a question which I'll address in a second. So there is the question of, again, you're looking at bringing forward deductions if income is going to be a bit lower in the following year, perhaps deferring income, all the usual things just from a timing perspective. Note the instant asset write-off for small and medium businesses. So now that's been extended for another 6 months. There's not such a rush to do something by 30 June, although that might be something you might still want to do. Obviously, all the ads on TV would say to go out to Harvey Norman and Bingley and wherever and Bunnings or whatever and get your buy things or go out and buy a ute for tradies, those sorts of things. So that may well still be a consideration from a timing perspective, but at least and actually we have larger businesses who we might go out and buy a truck or an excavator or something like that. So because the threshold is 500 million, even some of our very large businesses can still qualify for this. So, but now you've got another 6 months. So, and that assumes that you actually want to spend the money, particularly for large purchases. You get a tax deduction, but they actually want to spend the money. So that's there. So I think that was probably pretty much all I had, Nicola. I'll just address Paul's question and any other questions that anybody might have before I hand over to Tom. So I'll read that out. So Paul has asked, can wages to directors be paid by credit to loan account? So Paul, you've got a small company with 150,000 of net profit prior to paying wages to 2 working directors. So, and credits of salaries to loan account, okay, for the cash flow boost. So I think I would say the position there is that, yes, certainly crediting a loan account, there is case law that will say that crediting something to a loan account can be treated as a payment. It's evidence that a transaction has happened. It doesn't, that the cash doesn't necessarily been paid. You would want to reflect that in the payroll of the business, or in some way just show that as, yeah, you are paying wages, deduct the PAYG withholding. So, show that appropriately on the activity statements. So that's certainly how you would get the cash flow boost, if you can report it in that way. And certainly, yes, I agree that definitely that would be a way. And just on a related point, I mean, if they were looking at JobKeeper and qualifying for as a business participant, if they weren't actually being paid sort of wages as such, then only one of those business owners, directors could qualify as a business participant of the company. So, whereas if they're being paid through the payroll and they are employees, then they could potentially both qualify. So that's something you might want to look at and consider as well. If there's no other questions from a tax perspective, I might move on to maybe some of the more practical sort of day-to-day business things, which Tom can start off, and then Nick Guest from our corporate advisory division will join us, and he'll talk about some of those aspects as well. So Tom, over to you.
Thanks, Pete. So thank you, Nick. So I think Pete's probably given a fairly good summary of the tax strategies there at year end. Admittedly, we probably are 5 days out from 30 June. So if we're going to act on something, we need to act probably pretty quickly. So I'll be covering probably a bit more of the commercial side of things. And I suppose, given this time of year, this is probably the time of year where a lot of businesses across Australia are probably starting to set their budgets for the next year, looking at their forecast and projections. Sorry, just had a question pop up. Looking at forecast and projections over the next sort of 12 months. And then also facilitating strategy days is a pretty common theme through June and July. So looking at how we actually can achieve those goals that we're setting. But obviously this year is probably a little bit different in that we're all confronted with the situation of COVID. We've entered a recession, and we probably need to think a little bit differently. So what we'll cover off on first is there's just, when we're putting this webinar together, two of those sort of hot topics that were pretty commonly raised, we're just looking at commercial tenancies and employment issues. So in the context of COVID, that is. So we'll just spend a little bit of time giving a brief overview of that, and then we'll sort of dive into the broader strategy piece at the end to finish off. So Nick, can we just jump to the next slide, please? Okay, so commercial tenancies. So first of all, I'll just start off by giving a bit of an overview. So I'm sure probably most of you are aware of the federal code that came into place back in, I think it was in about April. So I'll just sort of give a bit of an overview of that just to make sure everyone's aware. So in terms of eligibility, so it applies to commercial tenants, and there's a defined term called impacted lessees, which basically means any commercial tenant where there's turnover of the group is less than 50 million and they qualify for JobKeeper. So obviously to qualify for JobKeeper, we're sort of looking at that. The key test there is the 30% decline in turnover. So once we've established eligibility, then there's a requirement for the landlords and the tenants to renegotiate in good faith, which is a bit of a sort of very open-ended sort of term, but we'll give a bit more on that in a sec. So essentially what the code's looking to achieve is it's basically put a pretty broad ban on landlords taking any prescribed action. So that, basically that just means any type of enforcement action on tenants. So, evictions, accessing the premises, locking them out, these type of things. So there's a ban on any prescribed action for non-payment of rent unless the terms are renegotiated. So basically what that's sort of saying is if once the tenant and the landlord have sort of come together and renegotiated their tenancy agreement, the lease, then orders can be applied after that going forward. So it's really putting the onus on tenants and landlords to come together and negotiate and help each other out. So the other thing that the code sort of covers is this concept of rent reduction. And I should sort of say that the code itself, it's more there as a guideline. It's not fully enforceable. So if a landlord and a tenant agree on one course of action, it doesn't necessarily have to be in conjunction with the code itself. But the guidance there in terms of rent reduction is that the rent reduction has to be relative to the downturn in the tenant's business. And the form that rent reduction would take is at least 50% of the reduction has to be a complete waiver of rent. And then the residual balance takes the form of a deferral, which is to be repaid over at least 24 months or the longer of the lease. So to give you an example, that's sort of a lot of words, but to give you an example, if you had a business where they've suffered from a 30% turnover, say, and they renegotiate under the code. So essentially the landlord's required to give a 15% waiver. So that's rent that won't ever be paid back. And then a 15% deferral. So in practice, it's been a bit of a mixed bag in practice, to be honest. Like I know we sort of dealt with one client recently where we were sort of helping them renegotiate with their landlord, and they're in the restaurant business. They'd suffered from a 40% downturn in revenue. So we entered negotiations with their landlord, and basically the agreement we sort of got to was, based on the code, we said, look, we're eligible for a 20% waiver on the rent and a 20% deferral, but we sort of said, look, we don't want to sort of we don't want to sort of accumulate a big debt that's still going to be there in September. So basically what we said is, can we just have a 6-month period with a 30% waiver, and then on the basis that we pay the residual 70% on time every month to keep the cash flow there for the landlord. So I think, again, just to make the point, the code itself, it's more for guidance as opposed to a hard and fast rule. And just to make the point, so obviously there's a little bit of difference between the states as well. So I know, like, for example, in New South Wales, out the prescribed period where landlords can't evict their tenants and things, that ends on the 23rd of October. But I know in Victoria, for example, I think it's in the end of September. So just sort of be wary that there are a little bit of differences between the states. There's probably more difference. So that everything I've said so far is probably from a lessee's point of view. There are some sort of concessions available for the lessors as well. And most of them probably stem around looking at sort of, I know in ACT, for example, they get a rates waiver, but in New South Wales, it's a 25% land tax reduction on the basis that you've passed that on to your tenants, and you can sort of show that. So that's sort of just a brief overview, I suppose, of what's covered in the code. And again, that's sort of been out there since April, so that's a little bit sort of old news. But I think in terms of practical issues and tips, if you haven't already, engage with the landlord. So obviously, if you're eligible for JobKeeper, then you've got the code to be guided by. But even if you're not, I think if you're not, you can still enter negotiations. The only difference is your landlord's sort of not required to act in accordance with the code, but that doesn't, don't ask. If you don't ask, you don't get, sort of thing. And in our experience, landlords have been, well, it depends on the landlord, obviously, but in general, I think it's been a pretty, I think people have been pretty reasonable and understanding in my experience personally. Just the point there to check the terms of your lease. So that actually, we had a bit of a interesting situation with one client where they were on I think it was a 5+5 lease, and they were in the 3rd year of the first 5, and the agreement was stepped increases of +5% every year, but actually in the 3rd year, there was a clause in there that there would be a sort of renegotiation of rent back to market, which actually our client wasn't aware of. So when we went back to check the terms of the lease before we entered negotiations, that was actually pretty helpful because, obviously we sort of went through and talked about the 6-month prescribed period and renegotiating on that basis. But also then by checking the terms of the lease, we sort of found that we can actually probably extend that over a longer period given the drop in market rent. So just, I think, important point is actually to check the terms of your lease and make sure you're across those before you enter any negotiations. Other than that, also if you do enter negotiations, just making sure that any agreement is documented. It doesn't need to be overly formal, but just sort of making sure that you've got it in writing and it's well understood, and just in case you sort of end up in any disputes, I think just having followed that step will obviously be of great benefit. And then just a few practical issues around what information do you need to provide. There's not a whole heap of guidance around that at this point, but in our experience, I mean, I think it's just once you've confirmed, I mean, obviously the key is confirming, if you're going to rely on the code, confirming eligibility for JobKeeper. I know some tenants have some landlords have required, they want to see accounts, and I've seen other landlords that want statutory declarations and things like that. But just making the point that there's no sort of formal guidance on that point at this point. So it's just pretty much whatever's reasonable or whatever the landlord sort of wants to see. And then even just another practical issue, what if turnover is better than expected? Again, we'll probably touch on this point a bit later, but we've sort of seen where a couple of people signed up for JobKeeper on the basis that they were forecasting a 30% decline, but then turnovers actually, and then they've sort of gone and renegotiated on that basis with the landlord. And then turnovers actually, it hasn't been as bad as first anticipated. Now, again, the legislation itself doesn't actually contain any sort of clawback provision or anything like that. But again, I think it's whatever it's probably done on a reasonable basis. Again, I would say. And then just the last point about, you'll attract more bees with honey. We also act for a property developer who's a landlord who, I think they had a pretty interesting example, which I think is worth sharing. This is probably pretty intuitive point anyways, but they had sort of two tenants that both engaged with the landlord to request a renegotiation of the lease terms. So the first one was a hairdresser, a commercial tenant hairdresser. They were relying on this code, and they sort of came forward and said, look, we're not trying to sort of take the mickey or anything. We're in a bit of precarious position, very, very open in their communication style, sort of, open, giving a lot of information and very empathetic in their approach towards the landlord. And they sort of, I think they were down about 60% revenue. So, the landlord was really good, sort of, they're good tenants, they have a good relationship, was sort of very willing to help them out, versus they had another tenant that took an entirely different approach and sort of came in all guns blazing type of thing, trying to throw their weight around and saying, if this is non-negotiable, if you don't drop the rent down to X amount, then we're gonna look elsewhere and things, because the terms of that lease were nearing the end. Sorry, the timing of the lease was nearing the end, and that just was obviously not a great sort of situation, and the landlord was obviously in that situation a lot less willing to sort of give anything extra, if that sort of makes sense. So again, probably a pretty intuitive point, but just I think something that's important to be wary of. So just now, employment issues. Thank you, Nicola. So just to cover off on this a little bit, again, looking at some of the amendments to the Fair Work Act. So again, this sort of happened a couple of months back, but just talking about this concept of the JobKeeper enabling directions. So again, if you're an employer and you're eligible for JobKeeper, there's been a lot more flexibility and a lot more power that's sort of been given to employers to manage this period. I know we saw at the end of May that unemployment rates were up at 7.1%, so there's a bit of a spike, and that's sort of that's obviously while JobKeeper's in place. So I think the big question is what's sort of going to happen after September. But I think this sort of there's been a lot of flexibility introduced into employment law over this period. And I should just say, obviously, just a sort of a little proviso to what we're sort of saying here. So obviously we're accountants, we're not employment lawyers, so we can give general advice on this type of stuff. But if there are any sort of questions that are around specific issues and that, we'll sort of might take them offline, and we've got a pretty good network of employment lawyers we can refer you to if there are any sort of hairy issues that you think you need help with. So just to cover off on some of the amendments, I think first of all, the power to reduce or increase hours. So once an employer has established eligibility for JobKeeper, basically they can issue a directive to stand. There's a lot of flexibility. You can stand your workers down. You can reduce their hours. You can increase the hours. You just got to issue the actual direction. There's also a lot more power to sort of alter the workplace duties and location. And I'm putting brackets there where reasonable, because you're not going to put the receptionist on the heavy duty, removaling, heavy lifting sort of a role. But I think there is a lot more flexibility to utilise people in other parts of the business where practical, and move people around. There's also the power to issue sort of leave orders, so to ask employees to sort of take more annual leave or eat into their long service leave, and things like that. But there's a bit of a cap on that, so you can't. I think the minimum on that is you can only go down to 10 days of annual leave. You can't force an employee to go past that. So just wanted to touch briefly on just a few interesting sort of cases. I mean, obviously with that extra power, there's been a lot of cases sort of going in front of the Fair Work Commission with employees trying to fight the employer's directions and things. So one interesting case that was sort of quite recent, which came out in the last sort of week or so, was there was an recruitment business where basically they sort of asked one of their employees to take a 71.5% reduction in hours. Now that might seem like a sort of weird percentage reduction, but the outcome that ultimately achieved is that the employee was basically only working the hours to meet the JobKeeper amount, so that they earn the $1,500 a fortnight type of thing. And actually, I should say on that point, I should just sort of point out that if you are going to make if you are making a direction, you can't vary the rate of pay. You can only vary the hours. So what I mean by that is, if someone's earning, say someone earns $100,000 salary, and you want to knock them down to say $40,000, the only way you can do that is by taking three days away. You can't sort of force them to keep working 5 days for less money. You can only vary the hours, not the pay rate. So sorry, back to the Fair Work Commission ruling. So yeah, this 71.5% reduction. So as I said, they were in a recruitment business. They were pretty heavily impacted, the business that is. So I think their revenue is down very heavily, and also the cash flow had been negative for 2 months. So they issued a directive to the employees that they could only work the number of hours that basically matched them to the JobKeeper payments. So in this employee's case, that was 12 hours a week. So the employee tried to contest that with the Fair Work Commission on the basis that he's the sort of sole breadwinner for his household, and on the basis that he'd generated $20,000 of revenue in the month prior, which he felt was, grounds for him to work more hours. But the Fair Work Commission sort of found in favour of the employer. So they were sort of saying, like, basically the factors that they sort of really looked at, and it all sort of comes down to what's reasonable. The question is what's reasonable, and that's probably the main thing to consider. But the main factors they sort of looked at were the fact that the employer, obviously the revenue, the decline in revenue, but more importantly was the negative cash flow. So without that was probably the biggest factor that sort of saw the commission rule in favour of the employer. And it works the other way as well. So there was actually another case recently where, I'm sure it's been pretty well documented that a lot of people with the $1,500 per fortnight are probably earning more now than they were pre-COVID. So one employer basically issued a directive to ask casual or regular casual staff to work 25 hours, which was more than they were working pre-COVID. So that got disputed as well by a few employees. And again, the Fair Work Commission actually found in favour of the employer there. And I would say I think that's probably been a fairly common theme. Again, it sort of comes back to the question of what's reasonable, as I sort of said earlier. But in general, a lot of the Fair Work cases are sort of tending to lean more towards the employer, because, as I said earlier, I think they're probably trying to protect jobs and keep that unemployment rate as low as possible. But I think as a sort of general comment, I think what you can sort of see is in the past, I think employment law has probably been a little bit weighted. There's been a lot of power and a lot of protection for employees. And I think in a situation like this, where we're looking at recession and things aren't as good as they once were, we're probably seeing more of an equalisation and some power sort of shift back towards the employer. And then just another point there. So I know Parliament this week have been looking. A lot of those legislation was sort of intended to end around the end of September. But I know Parliament have sort of been talking this week, just looking at whether they can extend that flexibility past September to help with the recovery and keep people in jobs. So this is a very, very dynamic area. It's changing very frequently, and I think it's very situational as well. But as I said, if anyone has any questions, I'd throw them out, and if they're a bit sort of niche, we can sort of probably reach out and talk about it afterwards with you individually. So yeah, that's just a bit of an overview on the Fair Work Act amendments. But I suppose more broadly, as things are now starting to relax, I think just sort of a few points to consider in terms of what we should be doing now. So I think the first point is, as particularly up here in New South Wales, you can start to see it. I'm in the city today, which is, I haven't been in here much, but you can sort of see that there's more and more traffic starting to come back in the city. And I think for employers, it's really important to effectively maintain the safety of your workforce, and that's from both a physical sense and a mental sense. So, physically, we need to put the sanitizer around everywhere and take steps like that, social distancing, things like this. Also, we've got to, monitor and keep on top of all the government requirements as restrictions change. It's a very dynamic area, as I said, and there's actually a lot of variability between the states as well. So if you're an employer that's got employees in many states, I'd urge you to sort of keep on top of looking at different states. I mean, obviously with what's going on down in Victoria at the moment, then, they could sort of enter more of a harsher lockdown, and that could change pretty quickly. But again, I think at a high level, I mean, what you should be doing is sort of trying to assess your risks and look at your existing policies and procedures and make amendments as required from a HR perspective, work health and safety, and again, operationally as well. And I'll touch on some of that in just a sec. And once you've got those policies and procedures in place, just making sure that once they're implemented, that you're monitoring them. And if there's any failures, making sure that you're taking steps to rectify. Just the last point there as well about considering the needs of all stakeholders as well. Like I know a lot of us sort of we're very focused on staff and things, but even clients as well. Like, in our business, bringing clients into our offices is obviously a bit of a risk at the moment. And, one practical issue that we're dealing with is we've got a big sort of audit division, and just sort of having policies in place on how we're actually going to conduct an audit if we can't attend a client's premises, or how we manage that risk, I guess. So in terms of, I suppose, the key items, just to sort of recap, I mean, looking at things like working from home. So again, reviewing the physical and the psychological health risks. Working at the office, looking at spacing. Do you need to implement sneeze guards? Is a bit of a practical one. Cleaning. Do you need to give training to help people spot illnesses? Flexible work hour policies, transport policies. Even, a lot of people can't. I know a lot of employers sort of are still urging people not to catch public transport, things like that. What happens if all employees need to quarantine? There's a lot of practical issues here, I think, that we that need to be considered. So I think on that's probably all I wanted to sort of cover for employment issues. So we might jump across into the strategy, and I think Nick's online, so he was sort of going to jump in here and cover some of this. I might hand over to you, Nick.
Good afternoon, everybody, and thanks, Tom. So this afternoon, we were going to talk a little bit about strategic planning. We find that the year end is often a very good point to take a step back, have a look at the business, and consider the strategic planning. And obviously the current period proves even more crucial to doing this. Most businesses have weathered a pretty sort of hectic period over the last sort of 3 months or so, and with the year-end results starting to come through, consider what the next steps may be. The first point on this, no matter where in the cycle you may be, is to always maintain your good financial hygiene. What we mean by this is making sure that all your statutory obligations are up to date, making sure your internal management accounts are up to date, and so that you have good quality financial information available to you, so that you can base your decisions. One of the most critical things which we always talk to our clients about is maintaining a cash flow forecast, and being in the habit of forecasting for the period ahead. And we would typically suggest that at least a 12-month forecast is important. And then when we look at cash flows most specifically, we talk about a 13-week rolling forecast. 13 weeks being a sort of assumed period of time, which will typically cover at least 1 quarter of trading activities and capture most of our lumpy statutory obligations that may fall into that period as well. There is the saying, cash is king. So understanding where our cash is going, where we're likely to receive cash, and how we can address our trading activities is crucially important, particularly in the coming quarter, as Tom touched on. Some of the financial stimulus being provided by governments through JobKeeper and the like would be starting to, at the moment, the forecasts are starting to wind off in this period of time. Likewise, potentially some rent abatements and any other arrangements you may have come to with your financiers around deferments on any finance arrangements may also be starting to wind down in this next quarter. So really having a really good grasp on what your obligations are going to be is crucial. And it's not just our own internal financial position we should be aware of at this stage. I think it's really is important to be looking at our counterparties, so our key customers and potentially our suppliers as well, and just trying to understand what their financial situations may be and how that might impact on our business if they were to start to slow down on either their ability to supply us or from our customer side, if who we have provided credit to, if there's going to be any delays in receiving funds from those parties. We probably want to have an idea on those so we can both work commercially with them, but understand what impacts that might have on our viability. Moving beyond that, and once we've got some good hygiene in place and understand what our near-term cash requirements are, I think it's really important to start considering around what we can actually do strategically to make sure that our business is in its best position. Now, I do absolutely appreciate that for some of us at the moment, we've just been holding on and really needing to ride out the storm. But I think it is important that we do take a little bit of time to think not only about working in our business, but sort of working on the business as well, and stop and think. Is our core business proposition still viable? Does it make sense in the current market? Is there an opportunity for us to innovate and evolve our business to really meet potentially emerging market demands? Also consider what some of our competitors are doing. These times do sometimes create opportunities for us to potentially take on some new business, but it also may create some irrational behaviour from other competitors in the market. And it really is prudent to have a look at what our competitors are doing. If there's some deep discounting in your industry, consider whether that is viable for you to try and match that and continue to take cuts to your profits. In some certain circumstances, that may be a strategy that's worth pursuing for a period of time, but you really would want to understand what the long-term impacts or even medium-term impacts of being able to do that is, if it's not going to be adding profitably to the business. Potentially being smaller and more profitable could be a more prudent strategy than chasing any work for reduced margins. There's also potentially from this adversity in the current market that could be some opportunities. And again, it can be hard to look at this, but I think it is important to be looking forward, seeing if there is opportunities for us to pivot and take a good look at both our internal processes and operations, potentially gain some efficiencies in what we do, but also position ourselves in the market to respond and really map out a pathway for the rest of this, well, for all of financial year 2021, but also beyond, and obviously considering risk in that as well. And the third part that we look at here is really around strategy and the longer term strategy of our business. And notwithstanding the current environment, what are our longer term objectives? What are the goals of the operators and owners of the business? And how can we translate from the longer term objectives into daily and weekly action? So bridging the vision down to a strategy. For us, we would always recommend documenting a strategy, and this goes for all organisations, but I think it's really important to actually take pen to paper. If you haven't already, capture what your long-term strategy is for the business, and then on a frequent basis be transcribing that into the shorter term budgets, and whether that be for the next annual period but then also into the actions you're going to be taking to try and meet those goals. Because without documenting it, it becomes hard to when you come to doing any sort of review and understanding how you may be progressing towards meeting the longer term goals of your business. And it is a really challenging process, but we always suggest that starting is the hardest part. And then once you've started a process, having a little bit of energy to run through it, and once you've captured it, it can be a really rewarding process. And it can also be very motivating for the business operators to be able to track their progress against that, and also help in communicating with other stakeholders within the business, whether that be the leadership team and the employees, so they can help align their actions and their goals with the overall strategy and objectives of the business. So it's a really important piece. Now, for private and family businesses, I think there's another arm to this, and that is linking both the interests of the owners of the business and they who may be family members with the operators of the business, whether that be certain members of the family or whether that be third-party management as well. And truly, maybe at times you may need to draw distinctions between what is a family objective and what is the business objectives. And being able to clearly articulate that, providing some guidance to individuals around their roles, and particularly if there are family members who are non-operational in the business, giving them prudent and necessary information around the business, but potentially excluding them from day-to-day operating decisions in the business if that's necessary in the best interest of the business. So defining everyone's roles and again providing clarity around that process can be really important. Best practice there maybe implementing something which we would describe as a family charter, which gives everybody an opportunity to have some say and oversight into various aspects of both the family operations, but also the business operations. And again, it's something that can be revisited and communicated on a regular basis. So that's a quick sort of overview of some of what we would be describing as best practice strategic planning at this point in time. It is something that we suggest that you would do at least on an annual basis. Putting in place that detailed forecast is important. Breaking that down to the 13-week rolling cash flow forecasts, and then have that all supported by an overarching strategic plan for the business, which is likely to be a multi-year strategic plan, which would be then broken down into sort of some annual objectives. I think we do have a poll question here, which is, do you have a formal plan in place for the next 12 months?
Maybe, and Nick, maybe just a comment on what the last part you were talking about with the family businesses. So obviously what we see a lot of is the succession. I mean, you haven't even talked about succession, because that could be, you could talk for a long time about succession planning, but that is obviously in the longer term can be a key part of all of that, is that your short and medium term planning, will especially from the family perspective, will need to fit in with the succession ideas, particularly with those family members that aren't involved in the business. And I think we see quite a bit of that.
Yeah, Peter, I think that it's a hugely important part, and that's when we suggest from a starting point for the planning would be, we'd be talking longer term, and you may not be able to solve all or resolve all issues at day one, but I think it is really important to consider everything about the future and what are the sort of the ambitions of and goals of the various key stakeholders. Succession often is a very important one, and that succession may involve family members wanting to be involved and desire to be involved in the business longer term, or it may be that there isn't a great desire within the family unit for that succession, and then at an operational level. And so then starting early to try and identify potentially key management internally in the business or recruiting externally still to run that business. So yes, it's a hugely important issue. And difficult and challenging at times, but I think discussion around that is very important.
That's right, because that brings you into structuring discussions as well. Because of course you can have just structuring discussions for business purposes, but then you also start looking at structuring for family and succession purposes. So, and they, as you said before, they may be different. They may be different purposes or different considerations, but it really brings you into all of those sort of things that need to be discussed, and sometimes structural decisions have to be made.
Yeah, and I think, Pete, you make a really good point there that often during these strategic discussions, it's worthwhile to bring in some other stakeholders, whether that be an external facilitator to help run and coordinate that strategic planning, and then specialist advisors at points in time where there be some structuring advice and or the like, and yeah. Capturing that.
That's right, because I'll immediately think about some of the tax aspects of that, but then people like yourself and Tom and a lot of the people that are probably on the call here will be thinking about the practical applications of it. So the point is that it's all got to fit in together, and you got to think about everything.
And just to add to that, Pete, I think from my perspective, what I've seen where strategies work really well in terms of that point about best practice, just to build on what you were saying, Nick, I think the two things I've always seen where they're probably more successful is, one, the strategy is sort of very clear and concise, so you're not sort of trying to solve all the world's problems. Like, I think just as important as setting a strategy is also setting what you're not going to do as well, is probably equally, if not more important. So we know what we're going to do, but we also know what we're not going to do, and it's clear, concise. And I think the other thing is it's well informed. Like, a lot of time you can sort of come up with a strategy, but actually having the market research to back it, understanding what your clients and or your customers are saying and what they want, having a sort of well-informed basis to drive your strategy, I think is also really, really important. And just that last point you sort of touched on, Nick, as well. So a lot of the time, strategies that don't really work, a lot of the time people are pretty good at articulating a vision, but again, it's sort of chunking that back into actions, steps that can be taken, and then communicating that really, really broadly. So, you always see, some people have the strategy, we want to be Australia's leading manufacturer of product X or something like that, but then they don't actually take the step to say, okay, well, to do that, I need a national presence, which means I have to expand into Brisbane or something, and actually sort of chunk that back into actionable steps. I think that's probably something to be wary of as well.
Yeah, and like I say, having the relevant people in the room too, or together, putting their heads together, so that that could include having when you've got different advisors, making sure that the family or the owners or the management are if they're getting advice from different areas, that all gets brought together, so they're not hearing different things from different people, which then can make it difficult for them to make those important decisions.
Yeah, and obviously the key stakeholders from within the business as well.
Yeah, absolutely.
There's a lot of important information sitting in different and various aspects of business.
So the question is, will paying or proposing dividends to directors or shareholders have an impact on the assistance available from the ATO? Now, I'm under, maybe, do you mind clarifying, when you talk about assistances, what sort of assistances are you referring to? Whether are you sort of referring to various stimulus measures, like COVID stimulus measures? Is that what you're referring to there? Yes, okay, good. So I'm getting where you're coming from. In some ways, not so much with dividends. I think when we're talking about JobKeeper, just to maybe touch on JobKeeper, which that sort of tied into Paul's question a little bit, where and that would be more from the point of view of if owners were registered for, say, we're talking about a company based on your question here. So with a company, if a company was registering for JobKeeper and you had owners working in the business who were not employees, so not actually receiving salary or even perhaps directors' fees as such under PLG withholding, then they could the fact that they're receiving their remuneration by way of dividends, that was the reason for the provisions dealing with the eligible business participants under JobKeeper. And so that's, I guess, the fact that they were being remunerated that way, that would assist. Although one of the annoying, I suppose, deliberate policy designs of that system, which probably would cause problems, I think, for people, is that they only allowed one business participant, which seemed a little bit odd in some ways. If you've got a couple of people, unrelated parties in business, particularly unrelated parties in business together, and the major shareholders in a business. So to actually two people in a business together, and they have to choose one of them to get the JobKeeper allowance and one not, it's pretty, so that's the sort of situation you or your clients could be in. One way around that is to have one of them receiving amounts through the payroll and one of them receiving basically if they're not receiving payroll, salary or directors' fees, perhaps because they're not as directly involved in the day-to-day operations, but they're receiving their profit share. They could be claiming JobKeeper as a business participant, and the other one claiming as an employee. So that can sort of work. But so I think that, the point of all of that is to try and maximise your JobKeeper claims for the owners, as distinct from just the day-to-day employees. And I guess that. Whereas the cash flow boost was really all about what went through the PLG withholding. So if people are receiving, so I guess the point there is if people are receiving dividends and they're not receiving salary, sometimes that's part of that strategy might be to minimise their payroll tax exposure, even though there are some anti-avoidance rules in the payroll tax laws, different states, to sort of try and stop people from avoiding payroll tax simply by taking profit share instead of dividend, instead of salary. But if that's the structure, the way people have set up their businesses, then that will, I guess that will be, I can see why that would be the case. But then that might cause them, as to your point of your question, that might cause them some issues with it might restrict how much JobKeeper they can claim. I mean, that's the main thought that occurs to me there. I don't know, Tom, if you've seen anything about that apart from that.
No, I think that pretty much covers it. Yeah.
Yeah. Okay. Unless anyone's got and feel free on the chat to throw out any other comments that anybody else there's quite a few accountants on the line here as well. So if you've got anything else to add from your clients, feel free to jump in. But that's the main thought I had.
So a big thank you to our panelists for presenting, and of course everyone else for attending. As always, if you'd like someone from the panel to contact you, please just complete the poll on your screen right now. A recording of the session and the PowerPoint slides will be emailed out in the coming days. So if there's nothing else, I thank everyone for joining us, and we look forward to seeing you next time.